How are we? Thanks for joining me today.
Morning.
Joey, good morning, mate.
Excellent. So I thought it was a good opportunity to come together because obviously in these times we're getting a lot of different questions from people, some people that may have been impacted by COVID and loss of job or a reduction in hours. We've got people that are still going quite well, got secure work, have got good equity in properties and are trying to continue how they're living and buying investment properties and things like that. So I had to think about it, thought we'd come together and just share everyone's thoughts on a few different topics and some questions that I'm getting asked quite regularly, and I'm sure you guys are too. So thinking about, we'll just go around the room, have a chat, and see if we can give some intel and feedback to our clients, and hopefully if they've got any further questions, they can come back to us and we can have a chat with them. So Duncan McKinnon, one of the directors here, I'm going to give you a nice tough question, one that I get asked a lot.
Thanks, Joe.
And it's a pretty tough question, but it's actually not too bad. I think people have to look at their own circumstances with a lot of things that we do. And wondering if I can get your thoughts on whether you think the Reserve Bank will cut interest rates further from where they are today.
Yeah, interesting question, Joe, and one that I think, it's one that I wouldn't like to speculate on, but I think if you go back and have a look at the recent Reserve meetings and the Governor Philip Lowe's comments, I think it was the first meeting of March, he said that it was very unlikely that the Reserve would cut below the 0.25% current cash rate. And he also said that the effect that the cash rate cuts or recent cuts had on the economy hadn't really had the stimulus effect that they were hoping. So he also referred to quantitative easing as being a possible stimulus measure as opposed to cutting rates. But I'd never speculate on where that would lead to, but that's just the recent comments from the RBA.
No, that's good. Okay, very good. Warwick, how are you, mate?
Yeah, good, thanks, mate.
You're looking well. Let's say the Reserve Bank does make an adjustment to the interest rate. We've seen that the last Reserve Bank cut wasn't passed on by all the banks anyway. What are you thinking in regards to what the banks might do with their interest rates?
Yeah, it's a very interesting question, and it's runs this territory at the moment. It's just it's unprecedented, and I think what Duncan mentioned as far as just the uncertainty out there in this market, I don't believe the banks will pass on any rate cuts if there was one to occur. I certainly think that with the current fixed rates on offer, that unbelievable record low interest rates, rates from 2.19%, for example, compared to your variable rates around the 2.83% mark, I just don't think it's going to happen with the passing any rates. And of course, the banks, and to their credit, they've done a lot of good things behind the scenes of the last month, and I think we've got to give our banks credit for that. Obviously, our shareholders and our banks are going to feel the pinch as well with the less return in their dividends. So I think we've got to be mindful that we've got to look after our banks in some respect to make sure they're going to be still profitable for us to survive, to get through.
Yeah, okay, excellent. Thanks, mate. So probably the biggest couple of questions we're getting at the moment, and Steve, I know you've got some good philosophies on fixed rates versus variable rates, and the fixed rates, as Warwick mentioned, are very low. We've never seen them this low, and the banks did a big cut last month or at the start of this month on the fixed rates. So if a client or someone's asking about fixed rates, what are you advising? What are you getting them to think about before choosing a fixed rate in this market?
Okay, well, I suppose when looking at fixed rates, we need to understand a couple of things about fixed rates, and number one is their limitations. So with a fixed rate, you're usually limited to how much over and above the minimum payments that you can actually make. So when thinking about fixing all or 100% of your loan as to a portion of your loan, that's a really important question. The other thing is that if you do break a fixed rate early, for example, you sell your house to repay the loan, you can be up for early termination fees. So again, we need to think about things like if you're choosing a 2 or a 3 year fixed rate, are you likely to sell your property in that time? And if that's the case, then you probably wouldn't fix the rates. So understanding that, and then understanding how fixed rates are actually determined. So Warwick just spoke about the Reserve Bank cash rate, and Duncan obviously as well. So fixed rates aren't directly aligned to the Reserve Bank cash rate. They're more reliant upon bank bill swap rates or a different market industry index as to where banks believe rates are going to be. Now, with that, historically, there's usually been about 40 to 70 basis points, or about 0.4 to 0.7% between the Reserve Bank cash rate and those swap rates in historical. Then the bank adds their margin on top of that. Okay. At the moment, that's about 4 basis points. So historically, it's never been, the cash rate and the swap rates have never been so close. And that's a really, really good indicator that right now is a very good time to fix rates. Historically, I'm not a big fan of 4 and 5 year fixed rates, because I think the other thing that happens is people's life cycle changes, things happen. So I'm very much a 2 year fixed rate sort of person. However, at the moment with 3 year fixed rates, as Warwick said, 2 year rates actually start from 2.09 at the moment, and we're seeing 3 year rates in the 2.29 range, which is just historically low. And because of the difference between your fixed rate and your variable, when you think about it, variable rates would have to drop quite significantly to get to those fixed rate levels. So look, I'm quite comfortable with my clients if they want to fix at the moment, just taking into account those other factors. Is something likely to happen in that period of time? And of course, understanding that you can't pay too much over and above the minimum payments. And if that's the case, if people do or want to accelerate debt, which is a big focus of ours at the moment as well, because rates are so low, it's a perfect time to be repaying extra money off your loan right now. Do a portion fixed and a portion variable, or look for a lender that may do a 100% offset account against a fixed rate. So that's my thoughts.
Excellent, mate. Good feedback. And I guess with everything, people got to just look at their individual household, how they're coping, and plan forward, just to make sure they don't get hit with any exit fees or anything with the fixed rate. Excellent.
Absolutely. And sorry, Joe, just that's where the conversation with your broker is really important, because I'll ask those questions to get an understanding of your situation.
Yeah, absolutely. Short-term and long-term goals, got to have that discussion.
Dino,
how are you there, mate? Sitting patiently.
Good, Jam. How are you?
Excellent, mate. Thank you. So we've got variable rates in this market, obviously, are very competitive as well, not as low as the fixed rates. So getting a lot of clients calling saying, oh, can we get a variable rate at 2.2%, and explaining that they are fixed rates. So what are you seeing with the variable rates at the moment? What are the banks doing, and what are you thinking with the variable rates?
Yeah, I like the variable rates. I mean, all the rates are really low, as Steve sort of pointed out. There's benefits in both fixed and variable. Ultimately, the rates for variable are as low as they've been for as long as we can remember. I mean, they might be higher than the fixed, but ultimately you've got so much more flexibility. So you've got a low rate. You can do things like redraw capacity. You've got the ability to make additional payments, fortnightly payments, all these things without penalty. In many cases, you get an offset facility, which obviously further reduces the interest content. So it's really popular in the current environment. That said, though, and just in line with what Steve's just said about fixed rates, I like talking to a lender or a product that allows you in the future to switch that across from a variable to a fixed or part thereof. So you've got a bit of flexibility in case the market changes or your own circumstances change. But for the current market, the variable rate, it's really competitive. You've got fantastic flexibility of options. So I'm really comfortable with that. But there is a portion where it's a really good opportunity to actually do a bit of a split facility, a portion of variable and a portion of fixed, just to lock in a bit of a rate, just to make sure you've got a nice low payment there. But then you've got the flexibility of what the variable offers. And it's just a matter of finding what that split is to suit your own circumstances. But great interest rates, and the products that are available at the moment and all their features, you can certainly get something to suit every person's needs.
Yeah, great. I think you just got to sit back and have a look at what's available, and just make sure you're, like everyone said, is thinking long term and have that flexibility. So yeah, awesome. Guys, thanks. I just wanted to have a quick call. It's awesome. So, bit of feedback for our clients, and I'm sure if anyone's got any extra questions, they can contact us directly, and we can go from there.